everybody. A very good afternoon and warm welcome to the research launch for the FSC, Investing in Volatile Times. Really appreciate everyone taking the time to join us today. In for a treat as ever. Really timely conversation, really timely bit of research. As we know, markets are kind of bouncing around. Consumers are kind of debating about where to invest. And against that backdrop, we've got really difficult and rising interest rates, high inflation, house prices heading south. If you're in the financial services sector today, there's lots of challenge. If you're a consumer in New Zealand, particularly financial services, you've also got lots of challenges. And I think the purpose of all of our research is to really shine a light on what is actually going on, and to kind of get a lens on, so what should we do about it? The FSC sits as the peak body focused and interested in on helping New Zealanders with their financial confidence and well-being, and all the research that we do is really helping to inform those kind of conversations. So again, really appreciate you joining. It's Richard Clippin here with you. In terms of the way we're going to run today, I'm just going to set the scene, frame it up, just give a little highlight lens on the research launch, and then really delighted to welcome a fantastic panel of experts from within the FSC community. It's always awesome to have different views and different perspectives from within the membership, people working on the front line, people seeing clients and determining what they're doing. So in that regard, thank you. We're on the record today, so welcome to the Fourth Estate. This has gone out far and wide in the media, and we've had some fantastic pickup with a lot more to come. And I wanted to pay tribute to Trustees Executors, who has been and is our commercial partner, our sponsor for this research and for many of our other pieces of research, and to the CoreData team, who are the engine room within which we do our research. So having great partners is always critical, and it's got us to this point. The other group of people, of course, I do want to acknowledge is the Fsc Research Committee, fantastic group of people from within the membership, ably led by Trish Oakley. It's their work that helps determine what we research, what we talk about, what are the themes, what are the key opportunities, and to that group of people within the research committee, a huge big thank you. If we just move on, for those of you who are watching for the first time, the FSC has been doing long-term research now for 4 or 5 years. And for the last couple of years, we've been focused on money and you. And the idea within the money and you research is to unpack and understand where New Zealanders have been with their money, how they think and feel about money, what they do with it, how they think and feel about risk and insurance and protection. So it's kind of this broader wealth conversation. The FSC also picks up and does a lot of FSC member data. So we produce snapshots and insights. So that's what's really going on within our membership. Our broader research really unpacks what's going on with New Zealand consumers. So when you marry those two things together, we have a really good lens on what's actually going on in New Zealand in terms of how New Zealanders are thinking and feeling about their money, but also what's happening within our membership in terms of flows, claims across the whole part of the sector. And so if that's the backdrop and the context, let's just now talk about what's actually going on with money and you, investing in volatile times. So this piece of research deals with and provides input from 2,000 New Zealanders, where we went out and asked them a whole raft and range of questions. The focus of this report was really around investing, and it also correlated to some work that we did last year. So some of the data we're going to show you is a compare and contrast from last year to this year, and some of it's obviously brand new. What we're also starting to do within the FSC is to really tease into demographics. So how do younger New Zealanders compare and contrast to Gen Xers, with baby boomers, with long-term retirees? So interesting, to have that conversation. The other one is to look at gender. and to see what men and women are doing differently. And having just come off the very fantastic 3-month campaign on ISWA, or It Starts With Action, the gender conversation around money and you becomes really important, because there are different inputs, there are certainly different views, there are certainly different outputs, and it's a conversation that's huge within the FSC. And the last part of the puzzle, but by no means least, is also starting to look at some of the differences around the diversity and inclusion conversation. So how is it that different parts of the New Zealand community think and feel, invest, and so on? We have a long report here. I'm not obviously going to go into a lot of detail on it, but certainly it's going to be uploaded on the website. So for anyone who's interested in the longer form, totally commend both the research to you, but also some of the inputs and so forth. So let's just talk about some of the key highlights. So key highlight number one is that we know 4 in 5 of New Zealanders are investing, and the majority are using online. So if we think about where we are 2.5 years into the pandemic, we all know that our own behaviour has changed, but we also know now that New Zealanders' behaviour has changed. People have gone online, they've gone online to save, they've gone online to invest, they've gone online to get advice, they've gone online to get more information on all sorts of things. And previously we've launched the digital investing platform research. So we know that the uptake on things like Sharesies and Invest Now and Hatch has been huge. And that's translated into lots of things, but also bank accounts, KiwiSaver, and so on. Key finding number 2 is that micro investing continues to grow. So that's gone up from around 15%, currently now 18.6%, with another 15% intending to. So we asked the question of, do you intend to invest in micro platforms? And you can see some of the data turn up. We'll go into that a little bit more detail. We're in very volatile times, and so again, some of the data that you'll see come through in this report is that we've come out of. We went into COVID, and there was a very significant market correction in March, April of 2020. And what we then saw is, as the money supply got turned on from the Reserve Bank, asset prices started to boom. Stock prices started to boom. Property prices started to boom. People started to invest in lots of different things. And of course, the huge uptick in micro platforms has absolutely seen that. What we're now starting to see, and what's coming through the research, is that people are making very risk-based decisions. All of us who work in the sector often think about, how do we grow wealth? Increasingly in volatile times, it's actually, how do you hang on to your wealth? How do you protect your wealth? And so that kind of risk-return trade-off is really significant, and certainly coming through the conversation in key finding number 3. And it's also a little bit different for men versus women. So men more aggressive in their investment outlook and their risk profile. As a generalization, women much more conservative, as it's come through in this research. So kind of interesting to look there. Key finding number 4 is around ESG. And again, note that the FMA put out some recent information and reporting on this. So what we're finding on the ESG conversation is, all of us want to invest according to our values. We don't want to be generally investing in things that harm people, harm communities, are detrimental. And so the kind of whole ESG conversation is around, can you invest? Do you invest? Do you want to invest according to your values? What's really interesting here is that 85% of respondents are not. Now, that might not be an active decision, but there's certainly pieces around, I don't quite understand, it's not really quite clear to me. I think as a sector, we've got a collective effort to focus and to make this really open, transparent and clear, so that people can make informed decisions. And of course, there's that whole greenwashing debate that's kind of running around the marketplace and has been for a while. So that kind of understanding piece, understanding what it means to invest according to your values, understanding the trade-off, if there is, on what you're paying for that, on what you're getting for it, on investment returns and so on, I think is, again, a really interesting debate to have. And I hope the panel picks up on some of those issues. Finding number 5 is around cryptocurrency. So again, this has been around, digital assets has been around for quite some time. I often get asked in the media, what's your view? And I generally take the view that if you don't understand something, get to understand it before you invest. And so this question around cryptos and digital assets is one that's obviously still alive, been with us for a while. Understanding is relatively low. Intent to invest is heading down, but one of those things, again, interested for the panel to unpack. And finally, key finding number 6 is kind of really interesting. Again, we've all gone online. That doesn't mean we're all safe online. Doesn't mean that we go to websites and so on. We know phishing and scams has risen, continues to rise. People continue to lose money, making perhaps ill-informed decisions about what to click and where to invest. And if it sounds too good to be true, it probably is. But concerningly, but interestingly, the privacy of and security of our personal information as a key concern has had a notable drop. So I think, again, that's one for all of us to take stock of. All of us, whether we're in the advice space, product distribution space, investment space, one of those things that I think we really need to watch out for, because resting on our laurels and going, this is okay, and nothing's bad is going to happen. I think the reverse is absolutely true. It's not a matter of if, it's just a matter of when, and we need people to kind of really be on their game around security and privacy of their personal information, where their assets are, where they invest, their passwords, and so on and so forth. And I think there's plenty of work to be done there. What I just wanted to do is to give people a bit of a sense of what the key findings were out of this report. In summary, volatile times are challenging times. Things are going down rather than up. That's different from, say, the last couple of years. People are much more risk averse and kind of making appropriate decisions. And the shining the light on this conversation is one that I'm going to leave the panel to discuss. Couple of last closing comments, if I may. We're obviously sitting today on the second day of Money Week. So the show today and the research launch is all about how do we support and how do we help New Zealanders think about money, get better with money, and Money Week and the work that the Retirement Commission is fantastic. We absolutely support it. We work closely together, and I know there's lots and lots of events taking place right across the sector in the umbrella of Money Week. So more of that, I think what we've learned out of the ISWA campaign is when we do stuff together, when we collaborate together, when we look at things together, it's a much more powerful voice. We don't have to compete, although competitive voices are good. But if we're all on the same message, helping New Zealanders make better decisions, I think that's a really valuable thing. I think the other piece for me out of this research is that investment markets clearly are not static. And so decisions that people have made last year or the year before or 5 years ago are going to be very different as times and impacts change. We know that New Zealanders are still not confident enough with money, don't make good decisions enough with money, don't save well enough, don't manage their risks well enough. And I think that as a mission for the sector is one of the things that we need to do. And so in that context, part of this research is exactly that. Shine the light on topics, help us to amplify it right across the market, both within our members, within the broader marketplace, and certainly through the media. And certainly been in Wellington last week, meeting with a number of senior politicians. They are really interested in the conversations and the research that we do. So I think that that's part of our mission. To the advisors on the end of this call, you're totally at the front line of providing advice to New Zealanders. So hopefully a lot of this information will be valuable in terms of how people are thinking and feeling about where their money is. And so, folks, on that note, let me commend the research to you. Let me suggest that there's plenty of reading for you to do. But to unpack some of the big themes and some of the opportunities, let me welcome this fantastic panel, ably led and facilitated by Clarissa Hurst, who's Head of Content and Comms for the Fsc. Delighted to welcome Dean, Helen and Ryan to the panel. Riss will introduce them more formally. And on that note, that's it from me for the moment. And Riss, over to you and the panel. Thank you.
Thanks, Richard. Kia ora, everyone. My name is Clarissa Hurst, and I'm Head of Content, Communications and Marketing here at the Financial Services Council, and I'll be facilitating the conversation this afternoon. So I'd just like to invite all our panellists to turn on their cameras and their audio, and I'll just give a brief little introduction to each of them. So first up, we have Dean Anderson, who is Chief Executive at Kernel Wealth. Now, after spending a number of years in the financial services industry, Dean realised that investment options needed to improve and investors deserve better. Taking a fresh approach to the investment sector, he created Kernel, a digital wealth solution where innovation meets investment. On the back of 5 years as head of product at a large ETF provider, he is an expert at creating, launching and developing index funds. And prior to that, he worked at the NZX, specialising in data products, licensing and contracts. Dean is committed to helping ambitious individuals achieve financial freedom through the creation of innovative financial products. He understands the investor challenge and is on a mission to change the financial future of millions. What a great bio. Kernel is also one of the newest members of the Financial Services Council, so a big welcome to Dean, who joins us from his car today as he's on the road for Kernel's Sorted Bunny Week Roadshow. Welcome, Dean.
Thank you. Yes, power of technology. It's a case in point that here we are up in a car using Zoom, which is great, but glad to be here.
Great. Love to see it. Next up, we've got Helen Skinner, Head of Responsible Investing at ANZ Investments. Helen has over 20 years of experience in the investments industry, holding various senior roles in both the UK and New Zealand. She's passionate about responsible investment, which highlights the importance of environmental, social and governance, or ESG, factors, including the impact of climate change into our investment process. She joined ANZ in 2022 after almost 5 years at Craig's Investment Partners, most recently as their Head of Emerging Wealth. Helen has been a part of the wider Fsc community for a number of years now in her previous role and her current role. So it's great to have you back with us. Welcome, Helen.
Thanks very much, Russ. Yep. I need to work on my profile to keep up with Dean.
And last but certainly not least, we have Ryan Bessemer, Executive Director and CEO at Trustees Executors, who are also our very generous research sponsor. Ryan was appointed to the board as Executive Director in October 2019, and he joined Trustees Executors as their CEO in April 2018. Previously, he served as Chief Operating Officer of Equity Trustees, which is Australia's largest independent trustee company. Ryan has over 20 years of experience in the financial services sector with a strong focus on general and technology management, investment operations, project management, and people management. He's got a proven track record in delivering successful business growth through organic growth initiatives and M&A. Ryan has completed the Program for Leadership Development at Harvard Business School, where he was selected to achieve lifetime alumni status. What a very impressive resume, Ryan, and it's a pleasure to have you with us today.
Thank you very much, Riz. It's a pleasure to be here, and it's also a pleasure to continue to be a sponsor for this research.
Well, it's great to have you all. Welcome to the discussion. Thanks so much for joining it, and to everyone tuning in today, feel free to use the Q&A box below to submit any questions that you have for the panellists as we go. I might pick up a few questions as we go if they're relevant to where the conversation's going. Otherwise, we'll have about 10 minutes towards the end of the session. So we'll try and get to as many questions as we can. I can't make any promises, but we'll see how we go. All right, so let's crack into the discussion. Now, over the past year or so, and Richard's already mentioned this, we all know, I'm sure many of you, if not all of you, have watched your KiwiSaver balances and your share portfolios plummet. Meanwhile, the cost of petrol, groceries, interest rates are all on the rise. We've got war raging in the Ukraine, a particularly persistent pandemic which refuses to go away. Nothing too major. Today, we're going to look at the research findings in the context of all of these things and the broader economic climate, and we'll get Dean, Helen and Ryan's perspectives on what's changed over the past year since we first published research into investing and the rise of retail investing, and also what's sort of stayed the same over that time. So Ryan, I'll start with you if that's okay. Now, Trustees Executors has obviously been supporting this research for several years now, and so you've seen, some of the trends over the years. In this particular report, we can see that 4 in 5 New Zealanders are investing, and so I'm just wondering what you make of that statistic.
Thanks, Riz. Look, I think there's a few things that we can take from this, and definitely, as you're saying, out of some of the past research we've done, we sort of found some of the the sentiments there were around trust, advice, and making good decisions. And really, in our industry, our main duty is towards making sure that we're creating a trusted environment, and we're breaking down the jargon to be able to create that continued trust in financial services. Where 4 out of 5, it sounds good, and I think it's definitely moving in the right direction. You still got 20% of the available sort of population that can invest who are choosing not necessarily to, and that probably to me is a little bit worrying. I think some of the things you can read into that really is around continued confusion about products and how people invest and what type of products you should invest in. There's also some traditional thinking around investing in property rather than investing in markets and funds, and I think that's part of it. But I think ultimately it comes down to literacy, and literacy is part of what we should be teaching our children, part of what we in the workforce should be teaching our employees. It's something that we should be self-learning around these types of products. We all have hard-earned money that go into investments like KiwiSaver and so forth. And that means a lot. And I think we've got this correlation that we've been speaking about for years, that the ability to be able to save and become financially independent affects your health and well-being. So we've got to continue to make sure that that consumers are still getting the right financial advice and the right education, training, and information they need to be able to make better decisions and to create trust in what it is we do. So I think it really comes back down to the fact that we need to continue this journey.
No, it's a really good point, actually, Ryan, because 4 in 5, like you say, it sounds pretty good at first glance, but then when you think about it, that means 20% of Kiwis are not investing, and of that 80% who are, who's to say that all of those people know what they're doing? That's a whole other killer fish.
Absolutely. And you see the FMA released their consumer sentiment report at the end of last week. It's very consistent to what we have produced at FSC. And it's really saying, well, KiwiSaver is the largest investment, and that's probably more because it's sort of default into it. But people making choices into investments is probably something that's not nearly done as much. And different demographics are making different choices. You've got your 18 to 34s who are investing more in micro investing platforms and things like that. So I suppose we have to be looking at how we create trust in all products, including those new platforms coming through.
I'll get to the micro investing a bit later on, Ryan, because I'm quite keen to hear your take on that. But before we do, Helen, one of the findings in the research was, well, some things are trending up, some things are trending down. Cryptocurrency is one of those things that seems to be trending down. Is that pretty unsurprising given the roller coaster that crypto has had over the past year or so?
I think it's probably a reflection of a number of things in the market. We've talked about volatility, and Richard's talked about in the research about the risk return element, and that I think it's about a third are investing on a risk return basis. So what we're talking about here is an asset which has a really high risk profile. Richard said there's not a lot of knowledge known about the background of it or how it works. And it may be that investors are moving away from it because they're reconsidering their options in this time of volatility. It may be that we're seeing a trend that we have in other market event moments when investors have moved down the risk curve. And so it could be that that those crypto, that if they are investments, are they that people are sort of having a punt or a play in crypto, or is it actually that they're investing in a long-term basis? So there's a lot that we don't know necessarily about those that are going into it, but I don't think it's unsurprising to see a high-risk asset having a bit less interest in it at this time of volatility. And as we know, I mean, we saw that last, when was it, March 2020, when the first blip in the market really happened, or the second blip that we'd seen in about 30 years, and people's panic, really, of moving their investments in their KiwiSaver. And I think we can, whether it's crypto or whether it's any other investment, there's an element of that decisions based on risk, which we will see.
Yeah, and we're definitely seeing, in the research, that there is more of a shift towards people wanting to safeguard their wealth as opposed to take those big risks. And maybe, Dean, do you think maybe that also explains why KiwiSaver is up? I think it's up by about 13%, which seems like great news. But how do we as an industry make sure that 13%, or those newer KiwiSaver investors, are making the most of it and aware of how they best utilise that investment to achieve what they're after?
Yeah, well, a number of elements to it, particularly around KiwiSaver. I think one of the surveys, we did a little micro survey ahead of the roadshow event, and 1 in 5 Kiwis didn't know who their KiwiSaver provider is. So I'm pretty sure that most Kiwis out there, if you're not even at the level of knowing where your KiwiSaver provider is, you're definitely going to be a wee way away from knowing, actually, am I in the right profile for my objectives? That is a significant step beyond just knowing who the provider is and where 3% of your paycheck is going actually every fortnight. So I think that's a key element there. I guess what we tend to see is probably a few things that have come out over the last few months. I think there is a lot of confusion being created around terminology, and we haven't done a good job at explaining things. There's been quite a focus on 3 buckets: conservative, balance, and growth, without actually realizing there is actually a broader spectrum in there. We've probably articulated poorly as an industry around conservative and being for something to use in 1 to 2 years time frame, and people have been caught by surprise so far this year, actually, with conservative funds going backwards. And I think we need to be better at that full round servicing offering and how do we articulate these things. And coming back on the trust element, reality is the sector has lost trust of the Joe Bloggs consumer. And a number of research reports, EY did a great research report in the US looking at this, and fintechs have now taken the lead in terms of consumer trust versus traditional financial services. And so there is a lot to be done there around reconnecting with consumers and helping them make better decisions. And that flows through to what we see with wider asset classes. That flows through to what we're seeing with the behavior around crypto and why younger groups and minorities are looking to cryptocurrency. If we look at that particular asset class, one of the things that does concern me from some of these reports and others, I would probably suggest that actually if you could probably plot engagement and adoption or investment use of crypto with its performance chart pretty high. But coming back to that overarching trust piece, anecdotally, we tend to see a lot of minorities or fringe groups using these more speculative or newer investment classes because they don't feel part of the traditional financial services system. They don't have an understanding of it, and they're looking to these as a golden ticket and something that they can use as a way out. And again, deviating from the original question, but the flow-on effect of this, which I think should be concerning of everybody and something we need to play a part on, is these groups don't have as much disposable assets, and they tend to invest 100% into these speculative solutions that come along. So there are a lot of things at play here, a lot of forces that are going on that we all need to contribute to, and helping people understand what is happening in the market, what to think about, and to get the mindset away from returns, away from, I guess, even to a degree, talking about the risk and actually talking about behavior and talking about the steps that they can implement, that they're the things that a consumer on the street can process and understand. If I put $100 a week away, this is what it's going to mean for me and why I should do that. And probably the biggest challenge around that conversation, the behavior piece, is trying to turn a behavior that is going to have a long-term benefit into something that's tangible for them today, because that's what we're competing against. We're trying to drive behavior, but we're competing against instant gratification of short-term speculative returns or any other thing that we are so accustomed to in our life. We've been hardwired now to be drawn to instant gratification from social media, from all the other things. And so there's a real tension there as well to try and get the mindset and attitude away from short-term focus into behavioral long-term outcomes.
I find it really interesting that we're having this conversation again, because thinking back to the tech bubble, very similar thing, that we had people going into investments speculatively looking for that sort of high risk return, and particularly now, given where we are in the market, that we've spent 13 years plus with very little volatility or very little sort of normative behaviour in a market. And so we've got this generation coming through, anyone who's pretty much in their 20s previously, maybe a bit more, has an experience this sort of thing. So we've certainly seen it when I was in the advisor network as well, that there's an element of younger people in the industry as well as in the public domain who are experiencing like long-term volatility for the first time now. And I know we'll get onto that a little bit later, Chris, but I wanted to kind of pick that up into this conversation as well, that I'm not sure it's a new thing going into speculative investments like we're seeing, but it's a behavioural point. Yeah,
we're repeating history. We've seen this throughout history, from 87.com. These heightened. Look, you can go back to New Zealand and look at what we saw even when we had the regional stock exchanges and the gold rush era. Human history and behaviour has a very consistent pattern in how we react during these periods.
It's a really, really interesting points that you've both brought up, and actually, as a former student of history, I can definitely agree that things do repeat themselves. It's frustrating to see at times, but at least, if we know what's happening, I guess it's what can we do about it? And that, I guess that's where the education piece does come in. And I suppose a lot of those newer investors now are learning these things the hard way, probably for the first time. And they're probably going, oh, maybe I should have listened to someone that had been through it before, but it's something you do have to go through.
I think there are some benefits, and I hope that this will be different compared to these previous events, where we've got a whole community now. We've got society engaged around investing and thinking outside of property. And KiwiSaver is at a scale now where people are engaged. The trick with this time around is that, okay, we've got KiwiSaver, we've got broad engagement. Can this reset to more market normality? Getting expectations back of what a good return is. It's not making 50% a year. Can we take that engagement and turn it into long-term behavior, long-term stickiness in terms of remaining an investor? I think heartening to date is we haven't seen panic selling, not just within the retail, but across the whole industry. The markets are down. It is resetting expectations. We haven't seen the panic selling out. So hopefully we don't have what we've had in the past, where we have a generation flee the markets and not return. Hopefully this is a good learning experience and sets up a whole generation for the future. But we've got to do that as an industry to really bang on this message now to make sure these people remain engaged and remain committed to a longer term mindset.
I agree with that, Dean. I was just going to say that thinking about returning to the market, and we had this generation previously which didn't. I've spent 16 years or something outside of New Zealand. So I was outside of New Zealand in GFC, and I was sort of a global exposure. But I saw that there wasn't the same, because there was a community of investors in different countries, there wasn't the same fear of the markets. There was a lot more conversation around it, and it was taken almost as an educational point. So, I mean, it was painful, don't get me wrong, but it was certainly something that was kind of talked about. And I think you're absolutely right, Dean, that when now we have this basis of KiwiSaver investors and other investments, and it's going to help the conversation along.
I think, Murray, I think a key thing here as an industry as well to think about is we have to do this through technology. People expect this to be a digital experience today. And, that is part of this conversation. This group is about using technology. People expect to be able to use things on their mobile in their terms, on their time. I guess the challenge I would put for the industry is exactly this point. It's easy to use technology to create engagement, to create and pull on those really emotive strings that create instant gratification. Look at social media. The challenge as an industry is to tackle the big challenge, the big question, which is creating long-term behavior, good behavior. And that has to be done through technology. It's a very complex thing to solve, though, a lot harder to solve than the more engagement-driven, short-term emotional drivers. So I think as an industry, that's the big question in front of us, and I know many will be trying to tackle that, but it's a complicated one. It's a lot more complicated to solve than instant reward.
And the industry now looks quite different to how it looked even just sort of a couple of years ago. We've got a lot of these newer platforms, and I guess Kernel's one of them, right? Popping up sort of left, right and centre. Obviously we had, Sharesies and Hatch were some of those sort of micro investing platforms that emerged and opened investing up to, your everyday person. And we're seeing more and more of these emerging. And I'm quite keen to get your thoughts on this, Ryan, because Flint Wealth is obviously one of those recent platforms to emerge, and Trustees Executors founded that alongside Research IP and Harbour Asset Management. So I'm just wondering what your take is on what's the role of these platforms, and are we going to continue to see more of them, and how are they helping sort of educate their customers to make better decisions?
Thanks. I think Dean summarised really well in terms of consumers really want more visibility, and that visibility creates trust. But we need to differentiate between this instant gratification versus the sort of long-term outcomes you really need from investment, particularly KiwiSaver. And I think these platforms are filling a market niche, but I think the platforms still have a lot of challenges, which is not just the ability to be able to invest and to be able to view your investments and be able to look at long-term performance, but also to be able to know what to invest in and be able to get advice onto the platforms or data and information on the products and services onto the platform. So I still think that's a challenge with with a lot of the platforms out there, although I think we're really heading in the right direction in this space. There are a number of new platforms come along. There's some great platforms like Kernel and Sharesies and Hatch and Flint Wealth, and they all have their sort of their market niches. And I see there's significant take up in these platforms. But I suppose as we continue to grow the fund under these platforms, we need to look at continued regulation of those platforms as well. I think there will be more, but at the same time, I don't think they're going to come along quickly. I think there's a lot of players out there who will look to see what people are doing well and not doing well and try to fit a niche coming through that platform. Some of the sort of, and I've said this before in the media, some of the sort of industry stalwarts out there who've been in sort of this investment space, in terms of retail investment space for a long time, particularly around platforms, but not necessarily online, their ability to keep up is limited because there's such large organisations focused on their internal machinations rather than on looking at where the consumers really need to be. And like we've said through this whole session, what the consumers want is they want to be able to trust their service providers and be able to give that visibility through platforms. I think is a good start at that.
Yeah, it's quite interesting, this conversation. I think it's a good segue actually into the whole ESG conversation, because we're seeing, with platforms like Mindful Money, they're sort of shining a light on where certain funds are investing, and consumers now can sort of log on and take a look and see, are their investments aligned with their values? And it's that trust factor as well, because if you can visually see, okay, this is where I'm investing, it does help with that trust element. Helen, I know you're very passionate about ESG, so I might direct this question to you. What do you make of the statistic in the report that 15% of New Zealanders are investing, to their knowledge, in ESG investments, meaning, I guess on the flip side, that 85% of Kiwis are unsure or are not investing in ESG investments.
Yeah, I love that. It's sort of to their knowledge. So it's those that might be thinking that they're actively making that decision. And I think part of the thing is we need to be really clear when we're talking about ESG and responsible investment. ESG is a risk, and it's a framework to be able to identify risks and opportunities for investing, right? So you're looking at environmental, social, governance elements. And there will be majority of managers, particularly those that are making active decisions, that they're using that kind of framework. It may be that they're not using it consciously or not actively kind of involved with it, or that's kind of the starting framework for them. So they might be thinking about governance when they're investing, or they might be thinking about climate change impact in another kind of industry, but they aren't putting structure around that, and they may not be engaging with those investments to try and encourage those companies and industries to do better and to be more sustainable in the way that they're operating. So, but from a consumer perspective, there will be, I suspect, a whole lot. There was 30%, I think, in the survey that said they weren't sure. And I suspect that is across the board. I mean, you're looking at, ANZ, we operate responsible investing. So we engage, we have engagements with different corporations and industries that we invest in, and we try and help them be more sustainable investments. We use that sort of ESG framework, and there are a lot of others that do as well. And so I think it's more around, are we as an industry doing enough when it comes to actually demonstrating what we're doing? And it doesn't necessarily need to be in some ways, it'll be a consumer-led decision. There'll be some people who have really strong values and really strong thoughts about where they want their money and their capital to go to. And we need to make sure that we are being as open as we can as investors to say this is how we're doing it, and therefore to help them make sure that they are aligned with where their money is going. But also, we need to make sure that we are generally doing good in the way, or thinking about on a sustainable and long-term path when we're investing generally. So I think it's kind of both sides. But when it comes to what's come out of the survey, it highlights what I think a few of us suspected. We're not doing enough when it comes to actually telling investors about what we're doing already.
Dean, what's your take on this? Because I know Kernel's also quite invested in the whole ESG side of things. You've got these sustainable funds, like your Global Clean Energy, your electric vehicle fund, and it seems like there's this barrier to about a third of Kiwis, and Helen touched on this, that lack of sort of understanding or certainty. Like, people just don't really know. They might be investing sustainably, but they have no idea. Is that sort of to your earlier point where you mentioned, we haven't really articulated things well enough, there's a bit of confusion over terminology? Do you think that's playing a bit of a role there?
Terminology is a big thing. Look, and I think collectively this group will understand, I think there's also probably for most people on the street a misunderstanding of what investing actually means, and that actually you're buying secondary shares on the market. So I think there is still a bit of confusion about what does this mean when you invest into something. I'm not physically giving my money to that company. Yes, there's rights issues and other things like that, but I think there is a disconnect there. That's a more technical layer. I think the language thing is the most obvious place to start. The FMA highlighting that people aren't reading the PDS. Well, we know that generally they're definitely not going to look into the, other material like documents and dig down into that, not only just for general information, but definitely not around ESG disclosures and definitions. I personally would love to see, and I know there's pushback from it, but I would still love to see the FMA take the lead on this and set some guidance notes around terminology use, because I think when we, as an industry, using language like green, sustainable, ESG, ethical, the consumer on the street is interpreting this as a very different, from a very different lens to what actually that may mean for that fund. And at the moment, you can kind of get away with quite a lot with how you apply some of those terms. And I think we should, at the very starting point, need to get consistent around language and try and be able to talk to that, because we've seen that with KiwiSaver. People do start to understand now, while I still think we need to go broader, conservative balance and growth. if we can start consistently using some language, the majority of the public can start to have a consistent lens around what those things mean and what the outcomes are. Then it can start to go into more technical layers of sophistication on that. But we're very early in this journey. And the reality is also that ESG investing is evolving very quickly. I think this is an issue for the regulator, and the industry as a whole. If we think about the first full ESG index with the S&P 500 ESG only launched in 2019. Now we've got indices and benchmark that are incorporating climate transition data. It's moving at a very quick pace. I think we need to have some guidance around language so we get consistent as an industry. I'm very much skeptical or not as a fan of using the term ethical. I think ethics is a very different thing than ESG. Yeah. And I think from the regulator lens, I think this slightly does tie back to the previous point of technology and ESG development are kind of both in the same camp. They're developing very quickly, and regulations aren't able to keep up with what is able to be delivered to an investor today. And that is a broad challenge from a regulatory point of view.
Crypto has the same issue as well. I mean, absolutely. We're talking about a continued changing environment where we've got emerging regulation, and we have to be feeding back this information to the supervisors and the regulators about what it is we think. I mean, disclosures is one part of this, and you can put data on to your website, whether it's point to mindful money or RIA data or whatever else. But you're right, Dean. I mean, it comes down to jargon. How do you actually then break that down to something that is understandable by the everyday person?
And Toitu Tahua, the Centre for Sustainable Finance, they've got as part of their roadmap taxonomy or a dictionary of terms to be built. And I know that there's work that's being done on that at the moment. So I don't think it's going to be long until it may not be that it's regulated, but it's something that will be out there for us to be able to all utilise. That's going to be great. It's being done globally.
There's some standardised sort of structure around the terminology in Europe. Obviously, the leaders in this space. The FMA seems reluctant or reticent to kind of put out a guidance note on this and putting it onto the industry to develop. Yes, I think the industry will, but I think all parties should probably collectively work around this if we really want to give better outcomes for the customer at the end of the day.
Yeah, I imagine there'll be an engagement element as part of that, and we will come to a conclusion. But it's great to see those steps coming through. Absolutely.
Yeah, I definitely see. From a supervision point of view, we definitely see the regulator engaging on those things and listening to the industry. And this is exactly where the Fsc comes in, and a number of its committees as well, I think, have been very helpful. And I think we push too much maybe back on the regulator sometimes, where we need innovation, but with that means there's going to be new products and services coming along, and we all need to contribute towards how we think that they should be working and how they're regulated.
That's true. I mean, we are doing it day to day, and I'm sure so the climate-related disclosure obligations are coming in. So first reporting will be in 2024, but everyone's working furiously on that at the moment, and it's great engagement process happening with the XRB on that. But I'm sure when that comes into force, and it's not just an investment, but it'll be across the board with those that are listed, but also there'll be insurance companies and underwriters and all that sort of thing. They'll be requiring climate and banks, climate-related information, and that I think is going to be a bit of a step change as well in the level of conversation that's happening around one little element being climate. But it'll be interesting to see how that gets the ball rolling and across the board.
All right. I think we can talk about ESG for a long time, and there's a lot to unpack there, and perhaps we actually needed a separate event or session to sort of delve into some of those things. But I just want to pull out one of the other findings from the research, which was around online security and privacy. So I'm quite interested in this finding, and to get all of your thoughts. Actually, it seems like online security and privacy is still a key concern, but that people seem to be relaxing their attitudes to it a little bit. We don't seem as worried as we were last year when we asked the same questions around this. So is this a reflection that, things are going great and we're actually more secure, or are we in fact, a bit more blasé and something's going to happen to wake us up very soon?
I think that it's a matter of consumers beware. This is becoming a more and more volatile space, and both in terms of understanding your own privacy information and the obligations your service providers have to you in making sure that your information is kept private, as well as the systems where your, for our sake, investments are kept secure. I think everyone, needs to understand that the internet is a public platform, public service platform, and really it's only a certain level of security, and your ultimate responsibility of your data is yours, and that means you have to understand what you're sharing, who you're sharing it with, how your data is being used, and also choosing reputable service providers as well. So I think there's a lot of responsibility that goes back on the individuals in sharing their own information, and there's a lot of responsibility that goes back on us as financial service providers, and about making sure that once that data is shared, that it is secure, we're tracking the data, and we have proper data management policies and principles. And there needs to be understanding at all levels across all of our businesses how that operates.
And we talk about data a lot in control and privacy and this sort of thing, but what we're actually talking about is people. It's us, it's our personal information, and we as service providers have to be really mindful that we've got this massive fiduciary obligation across our customers' information. And but I think to Ryan's point, I think we're in a bit of a danger zone at the moment, and that there hasn't been anything recently that's made massive announcements in the press, or that's I think it's likely, and from knowledge of working in these industries, the amount of bombardment that you get of attempts when it comes to wanting to breach cybersecurity. It's scary when you hear the numbers. So it's a good thing that there's nothing that's kind of blown up in recent moments, and I'm touching a lot of wood right now, but it does feel like it's a bit of out of sight, out of mind with some consumers at the moment from the results of the survey.
I wonder whether it's like to that broader piece. I think this sector in particular has that very strong fiduciary lens and very conscious of security. But from that response to the survey, I wonder if that does tie back to just our broader attitudes around data and data sharing. So if you think back a couple of years ago, that was actually the height of when there was a lot of conversation in the media around our data from social media platforms and sharing of information and privacy rights and what was being shared and all of that sort of stuff. And obviously that has faded away again. And I wonder whether that flow-through effect is just coming as a broader piece on my data is everywhere, and people are becoming kind of numb to the idea of where it is and how much touch points they have over the internet anyway.
All right, we're nearly out of time, but I'll put one final question to all three of you. I'll give you about a minute each, see if you can manage it. Do you think that we've learned anything from the pandemic and the recent volatility over the last 12 months? And if so, what have we learned as an industry?
I'm happy to start answering that. I think it's just a reminder that markets are volatile. They do go up and down. They're affected by a number of different factors. And I think Dean was mentioning before, we have to look at our investments as particularly things like KiwiSaver as long term. There will be volatility, and I think the concept of flip-flopping and making rash decisions based off what's happening in the market at any particular one time is probably not a short-term, so it's probably not a long-term view. But then it also comes back down to things like life stages, outcomes you're requiring, and all that sort of stuff. And that's why financial advice is so important. So particularly at this period of time over the last 8 or so months, where there has been significant change in the way the market is performing. If you have any questions, go speak to someone about it. Go speak to a financial advisor.
The first thing when you ask that question, I don't know if anybody's watched the movie Burn After Reading. At the very end, there is a quote, and it's, "What have we learned?" And it's a if I know, probably just learned not to do it again. And I kind of felt almost when we talk about it and think about the conversation on we're repeating history here, there's a little bit of that. Don't know what we've learned. Let's just not do it again. But I do hope that we have an opportunity now more than anything to establish the behaviour going forward. It's been an unusual few years. The opportunity now is what we do from this moment forward as an industry and make sure that we set up a good foundation for future generations.
Great answer, Dean. I love that movie. Helen, last word to you.
I was just going to reiterate both thoughts, really, that I think from us as professionals in the industry, we've learnt, well, we're in a point where we get to really show our worth. This is the moment when you want to make sure that you are losing as little money as possible in efforts to gain it in the future. But I think it's also really interesting and important time for all Kiwis. There'll be a few people out there which will be finding it very tough at the moment, and investments will be at the least of point of their mind. They'll be thinking about how they're going to pay their electricity bill. But there will be others who will be reassessing what they're in or thinking, actually, I need to know more about this. And I think this is a pivotal time for us to be able to capitalise on that. I know in one of the previous Fsc research reports, it was that about 20% of Kiwis got financial advice, and that shocked me at the time and still does, that we need to make sure there's quite often correlations between those that have a negative experience in investments, those that are making really quick decisions in investments at times like this. It all comes down to that advice element. So it's all around making sure that you are getting advice. Advice often comes with your product. Check out your KiwiSaver Investor. They usually have some kind of advice offering with it. Or you can check out the Sorted website that has some great pieces of advice in it as well. So I think we just need to make sure that that's the message that's getting out there.
Yeah, great way to end as part of Sorted Money Week. That's a good tip. So we're unfortunately out of time, so I'm going to have to wrap things up. But thank you so much again to all our panellists, Ryan, Dean and Helen, for your time today. And I'll just hand back to Richard to close up today's session.
Awesome. Thank you, Riss, and thank you, panel. And I think that's right. I mean, I think the challenge for us all is to take a conversation like this and figure out what we do with our clients, prospective clients, with our brand, our marketing, and so on. I think in the end, that's the challenge, because I think to Dean's earlier point, there's now scale in the system. The KiwiSaver system's got scale. The data's clear. People work with us every day. So that's a piece of trust. That's a gift. That's an opportunity, but it's also a huge responsibility. And the question is kind of what do we do with that? And I think that's where we can collectively do some great good. And I think also to Helen's point, people are doing it hugely tough out there. This cost of living crisis is real. There are people making decisions about whether they pay their bill first or feed their family first. So, again, that's in our hands to try and influence and help people make good quality decisions all the time. So to the panel, a huge thank you. To TE, a huge thank you. To CoreData, a huge thank you. And to the people on the end of this line listening, also a huge thank you. We are 6 weeks out roughly from the FSC conference, which I'm delighted to say, and this is hopeful as much as perhaps a sense of confidence, that we will be able to be in person together. I know many of us have been in rooms together. It's great to reconnect. This is a really powerful industry. The FSC conference is our flagship event. It is the gathering of the clans, if you will, our regulator partners, our political partners, the sector itself, our financial advice and service providers will all be in the room over 2 days in Auckland. Registrations are going great. Our political partners are all in, and like I said earlier, having spent the last couple of days in last week in Wellington, great interest to be in partnership with us. So join us for the conference. We are looking forward to producing that and certainly looking to reconnect and rekindle the friendships, the relationships, the partnerships and so on that we have. And so, folks, on that note, at bang on 4:30, Thank you again for joining. Enjoy the rest of your afternoon, and commend the research to you, commend it on the FSC website, and hope it's going to be of value to you, your clients, and to your broader business. And with that, kia ora and good afternoon.